All right, well, welcome back to the iWealth podcast, and today we're talking about Q2 of 2024.
We're here.
Got to make sure I get the year right.
Yeah.
And going back to last quarter, what happened?
Yeah, amazing quarter, Matt. I mean, statements are just starting to come out, so you'll see it. And not to any benefit of me. I mean, the markets have been darn good the first quarter. You know, you go back to 2022 and really tough year. Bond market, worst year since the 70s, like stock market down. And then you go to 2023 and we had this big jump in the market, led by 7 stocks. We call them the Magnificent Seven. We've talked about it. And what's interesting is things are rotating a little bit this year. So you still have, now it's like Magnificent Four. Like there's a new name as they kind of throw 3 of them out and keep 4 or 5 or whatever it is. But you're starting to see a little bit of shift back to value. So you're starting to see, what I mean by that is companies that are paying a dividend, companies that make money, you're starting to see that starting to come back in vogue, which is not unusual because growth has had its day. Like the last 2 years or the last 18 months, it's been all growth. I'm a simple guy and I understand colors and I understand stoplights. And so red is not good, you got to stop, yellow is caution, and green is go. And so one of the companies that we work with have these speedometers that they put out, and it's just a visual for us to take a look at and clients to look at. And those speedometers have been yellow and red for about the last year, and they just turned in March. 4 of them just turned green. And so there's still 2 red, geopolitical risks, so we know it's unstable with Ukraine overseas, and Russia and all that stuff, so we know that. And then price to earnings ratio, so that means how expensive is the market, how expensive are stocks to buy, that's red. And then there's a bunch of yellow on there. So, but the trend is good. And so, you know, we believe that the economy, the economists have been talking about, is this going to be a soft landing? And we hope so. We hope that maybe the Fed is going to be able to have this soft landing with this market, but we'll see. We'll see what happens. It's an election year, which typically is pretty good in the market too, as you kind of go forward with things. Yeah.
So I was just wondering, with a couple of these turning green, is this the time to go for it? Are we putting money in? We got a little green on the board. Are we going for it?
Absolutely, you're going for it. However, there's a caveat because I got to protect myself, right? So I don't say something wrong. It depends. It depends on when you need the funds, right? So you might say, let's say you had a pension, and the pension delivers to you $300,000 in cash today. That's never been in the market. Okay. What should you do? I mean, the market was up almost double digits, or was double digits last year. We're up 10% again this year already. Should you jump in with that $300,000 cash? What should you do? And the answer long term is yes, you should just jump in, but you could dollar cost average in. You could take 100 and put it in now, wait 3 months, another 100, wait 3 months and do another 100, and see what happens here to this market. Because we think volatility is going to happen. We haven't had any volatility. It's been up, except for the last 18 months. Volatility is going to happen. I think a 10% pullback would be really good for the market. Wouldn't be good for our statements, but I think it'd be good to just settle back down again with price to earnings ratios and bounce back off again. You know, back to the election I brought up, because I'm getting this question from clients, like what's going to happen with this election, and I don't know any better than anybody else. But history says a divided government is best. So when you have a Democrat in charge and Republicans in the next wing in charge, or vice versa, when they're all in charge, the market doesn't do as well. So whether it's Democrat or Republican. So a split government is good because then they have to come to the middle. That we think they never get there, but at some point they have to come to the middle. But since World War II, the S&P's averaged 13% in election years.
So election years are the good years. That's basically the takeaway.
Yeah, so avoid the noise that everybody wants to talk about.
There's a lot of noise in the election years. Yeah. Everyone's talking about who's going in, who's going out. So avoid that. And, outside of World War I and World War II, wars really haven't had an effect on the market either. So I'm getting that. What about Israel? And what about Ukraine? I mean, you go back to when the trade centers fell. Yep. Market panicked, things went down, and we were back within 3 to 6 months of where we were. Events have happened through history, and we tend to manage through them. And obviously, if China invades Taiwan, all bets are off. But this war in Ukraine, the Israel, everything going on, it doesn't have a big effect on the market overall.
outside of World War I and II. So obviously those were really, really big events. There's World War III, really, really big event, that's out there. So yeah, overall, just a couple things to keep in mind for clients. One, your statements are going to look good. It's because of the market. It's not because we're so smart and smarter than everybody else. The market does a great job. But hopefully you're diversified if you're working with us. And you're going to be in some of those areas as things change. As it goes back to value stocks, you're going to have some value stocks that'll be there as growth stocks start to dip. So diversification is key. Higher for longer for interest rates. We believe that the interest rate cuts that they thought last year the Fed were going to make aren't going to be as healthy this year. Like the market's already starting to back off on that higher for longer, which means that mortgages might stay in 6 or 7%. You might be able to get 5% on cash for a while. That's a good thing. There's nothing wrong with that. It's back to normal. But if you're 25 and you're buying a house, this means like higher forever, you think. Like we're never going back to 3%. So those are some things that are running through my head. I think market looks pretty stable for this year. There's going to be volatility. I think it'll be a decent market. And I like the fact that those economic indicators are starting to go from yellow to green, which is a good sign for this market.
Yeah, it's been a while since that's happened.
Yeah. Yeah. We're finally getting back into it. And then just a couple of things for our clients to let them know. So as you guys are aware, we've opened up the iWealth Financial RIA, Registered Investment Advisory Firm. We've notified clients, sent the emails, sent the video out explaining what that means, which is really nothing to them other than having to sign some forms. Like their account numbers don't change, taxes, fees, none of that stuff changes. But they do have some things to sign. And so I just want to remind you that those DocuSigns are coming, that stuff's coming in the mail. If you have any questions, contact anybody on our team. We're here to answer those questions for you. Super excited about like this next chapter and the autonomy and freedom that we're going to be able to have to work on the best investments for our clients. So
very cool. There you go. Well, that's just a little bit about where we were at in the past and hopefully where it's going in the future. So
all right.
We'll see you back here next time.
Sounds good. Have a great quarter.